Hi everyone, I'm Špela, he's Peter. We are from Lemur Legal and we are startup lawyers.
Yes, as Špela mentioned, we are lawyers that work with the startups. In the past and in the present, we cooperated with several business angels, with startup accelerators, incubators. So we have experiences with startups, and those experiences also include, let's say, some kind of know-how for the negotiations between the investors and the startups. So we have participated in the numerous negotiations, and some of them went very well at the end for the startups. Some of them went very well for the investors. There are many tricks that investors are using. So of course not mostly investors are good. They have good intentions, but there are also some risks to which startups definitely are exposed, and of course some of the investors are also using dirty tactics, let's say complex contractual clauses with hidden agendas, or what is very usual tactic is it's time pressure. You know, they put startups under time pressure to sign the legal documentation and so on. So what we will be talking today about is we will try, me and Špela will try to be very exact, very practical about these negotiations. So what's the process of negotiations? What are the clauses? Where are secret traps for the startups? And of course, please do ask us some questions. Now we will start sharing the presentation, so we will not see any questions. But after we finish our presentation, we will look at the chat, and we'll be happy to reply to everything. So this is all from me for now. Špela, do you agree? Let's continue. Okay, so now we'll start sharing the presentation, and as mentioned, we will try to deliver as many practical experiences as possible to you. So, but really feel free to ask anything. Okay. Yeah. So we start sharing. Okay. Okay, so what are the key messages that we'll try to deliver today to you? So startups are usually mistaken when they think that when they started negotiating with investors, with different kind of investors. We mean angel investors, VCs, also business accelerators. So the valuation, it's not the only leverage or negotiation tool that it's on a table. So there are also several contractual clauses which are put, as we'll see later, into different contracts, and all this is on a table when we are negotiating with the investors. So of course some of the contractual clauses are more in favor to startups, some are more in favor to the investors. What is also practice, usually money investments come with some kind of smart money investment. We'll see what is smart money and why startups need to be cautious about it, because of course investors would like to put into the company, into the startup, as less money as possible, and of course they would like to put their services in it and their connections. We'll see about these smart money investments and why startups need to be very cautious about. Also, one thing that startups need to be very cautious about is so-called mezzanine financing. So these are convertible loan agreements. This is a common practice, so that startups get this kind of funding. It's also very risky for the startups, and we'll see later why. And we'll finish with the finder's fee agreements. There is a lot of people, a lot of experts, some of them are good, some of them are bad. They are offering various services to startups, mostly related to how they will bring tons of investors. And of course, there is no free lunch. You need to pay for these services, and we'll see what are some traps to which they prey for the startups. Okay, so if we start with the process, what's the negotiation process? Of course, we often start with informal conversation, but sooner or later we need to start putting things onto the paper. Usually these are the key documents within the negotiation process. The first one is term sheet, then it's a share purchase agreement or maybe convertible loan agreement, depends on the type of funding, and then are articles of association. These articles of association are some kind of constitution of every startup, of every company. So here you can see a draft example of term sheet. The only purpose of the term sheet, this is completely non-binding document. The only purpose of term sheet is to start putting on a paper these most important clauses, this most important information about the intended deal. So as you see, what's the investment type, what's the size of share you are offering, so you can calculate the valuation, and then you can also put some clauses into this term sheet. And of course, investors would like to see clauses that are in their favor. So we'll see later which are those clauses. But this is something that usually the negotiation process starts with. So it's better to put things on a paper, because otherwise you will lose a lot of time, because expectations between startup and investors might differentiate, and when you start putting those clauses, those expectations into this kind of document, then practically serious negotiation starts. And after this term sheet is more or less agreed, then you can continue to the next phase, and the next phase is the negotiation of the share purchase agreement. So the purpose of the share purchase agreement is to seal the deal. So usually the share purchase agreement has some specific clauses in it. It can be a complicated document or not. It depends on the investor, depends on the startup. We have seen many different sizes of this kind of documentation. But of course, all of these documents have some things in common. What is the purpose of this share purchase agreement is that you define the clauses which are later included into the articles of association. We will not go through this the share purchase agreement today, but we will look at several of these clauses for which we think are the most important. So as we mentioned at the beginning, when you start negotiating with the investors, the valuation, it's not the only thing you can offer to the investors. You can also offer them some clauses which are in investors' favor, and these are some of the clauses. First one is a liquidation preference clause. If you read this clause, I will give you 10 seconds, and then I will try to explain to it. Okay, so I'm sure you understand it, but maybe you need some additional explanatory words. So of course, the risk for the investor is that he puts some money into the company, and a few months later, company decides to liquidate the company, so that they will stop doing business. And of course, if that happens, in case of liquidation, all the assets divide proportionally to all the shareholders. And of course, this is a risk for the investor, and that's why usually investors like to see this kind of clause in the agreement, because this kind of clause is protecting them that in case of liquidation, firstly, they will get their investment back, or maybe 2 times of their investment back, and after that, the assets will divide proportionately among all the shareholders. So this is a first clause, which is very favorable to the investor, or maybe not only to the investor, maybe it's also shareholders. For example, some of the founders, if not all the founders, are participating equally at the beginning of the company. So if somebody, for example, if some investor or some shareholders are participating with their money, the others only with their services. So, for example, for the shareholder participating with the money, this clause is also something that he or she should think about it. The second clause is anti-dilution clause. Me and Špela were listening to the session that you had before, and this dilution was mentioned. Of course, dilution is also something that investors are afraid of. For example, if we have a seed round and the valuation of the company is 1 million euros, investor enters the company, he gets the 10% share, and then startup in the next round, in the Series A round, the valuation is only, let's say, 10,000 euros. Of course, the share of the investor will dilute very much. So that is definitely something that investors would like to avoid, and that's why the investors would like to see, and this is very usual contractual clause. You will see it when you will be negotiating with business accelerators, with business angels. So this is not something that is not business as usual clause, but it's very often in all the agreements. So as the wording of this clause, you can see it. Look at it. There is a threshold set. So in this case, the threshold is set at 1.5 million euros, and that means that only in case the valuation of next round will exceed this threshold, 1.5 million euros, only in that case also the share of the investor will dilute. Otherwise, if the valuation of next round will be below that threshold, the investor share will not dilute. And of course, usually you cannot negotiate with the investors about this clause, whether it is put in the agreement and later into the articles of association or not, but you can negotiate with this threshold. So you can, for example, offer him investments under higher valuation, but then you also offer him higher threshold within this anti-dilution clause. So to repeat myself, this is very usual clause, and it is industry standard. So when negotiating with investors, with different kinds of investors, you cannot negotiate out this clause usually, but you can negotiate this threshold. Okay, Špela, your turn.
So a no-shop clause is pretty straightforward. It's meant to protect the investor, as it prevents the company from searching and asking investment proposals from other parties and negotiating better terms. So as you can see from the example, it usually states that the founders agree that they will not solicit, initiate, encourage, or participate in any negotiation connected to the acquisition or purchase of all the company. So it just basically protects the investor from losing his deal that was agreed on certain terms. Now, a drag-along clause is included to protect the majority shareholders. And the main idea is that in case of a sale of a company, the minority shareholders have to participate in the sale. So the majority shareholders, however, have to assure the minority shareholders to get the same price, the same terms, and the same conditions as they already established with the buyer. Now, the change of management control clause. This clause is usually incorporated into the contracts when the investors decide to invest in a company because of the founders. So people of the company itself are the main reason why investor decides to invest in the company. And the change of management control clause gives these investors certain rights. As you can see from the example, in this case, this clause gives the investors the right to terminate the contract and then sell their shares back to the company for a price that is already agreed upon. Now, the last clause is advisory board clause. This one is pretty simple as well. It also protects the investors and it enables them to appoint one member in case an advisory board is established in a startup. So with this clause, you give the investor the possibility to influence the business decisions on the long term.
Yeah, so what Špela wanted to say, that usually investors don't have powers to participate into day-to-day business, to have some kind of executive functions within the startup. But of course, you can always offer them some kind of advisory function. So this is also something that can be put into the articles of association, or even better, before into the share purchase agreement. And having this kind of role might make investors more comfortable when investing into the company. And this is something that we have seen very often when startups started putting this offer to the investor on the table. Okay, so smart money investments. I don't know if I should tell you that you should be a little bit afraid of them or not, but this is something that is definitely very hard to define, very hard to properly put into the agreements. What we have seen in practice is that investors usually approach startups and tell them that, okay, so we are ready to invest in your company 100,000 euros. Out of those 100,000 euros, 50,000 euros will be in cash and 50,000 euros will be in our services, because we are so well connected, we know the industry and so on. And of course, this is definitely very hard for the startup to properly evaluate. And this kind of this smart money investment can come in various forms. One is in the know-how, one is in the infrastructure. For example, if the potential investor is tech company, then tech company can offer you their infrastructure, so that you will be able to test your product. What startups are also searching are pilot projects. So this is something that poses a huge challenge for startups usually. So they have a product, they have some kind of proof of concept, and then usually they need some kind of pilot project with a very known and reputable company from the industry. So offered pilot project can also be considered as a smart money investment. And what startup accelerators are also offering is also some kind of smart money investment. They offer you part money investment and part investment in the form of the accelerator program. Okay, so how to evaluate it? We can give you few advices. Definitely be smart when you're dealing with this. So KPIs, key performance indicators, are definitely needed. So you need to define this smart money in details. I don't know, for example, if smart money it's a pilot project, then you need to very well define when this pilot project will happen, what will be the outcomes of the pilot project, what will be investors' input into this pilot project, and so on. So without serious, well-defined KPIs, practically this smart money investment is a huge risk for the startup, because once you give equity to the investor, it's pretty hard to throw them out of the company once they're in. So that's also the question we have given here. It's when to give this equity. So if it is possible to negotiate with the investor, but of course it's not always possible. But if it is possible, then maybe you should not give this equity in advance, but you can sign agreement, shareholder agreement, where you give certain amount of equity in advance and certain amount of equity once this smart money is actually provided. So once again, be very, very cautious, because of course the investors are willing to give you more smart money and less cash money investments, and you need to find a proper balance. And of course, it's always a question: what kind of investors are you searching for? So are you searching for a tech partner or a strategic investor? Are you searching only for the equity investors? In case of the latter, in case of equity investors, of course, from this kind of investors, you don't need smart money. Convertible loan deals. This is also something that you should pay attention to. It's of course once startup starts their business circle, their business story. Startup usually don't have any assets, no cash flow, nothing. So the valuation of the startups is pretty low. And when you're negotiating seed round, of course, that means that for a little bit of money, you will be forced to give pretty much a lot of equity. So the holy grail in this stage for every startup would be to get some kind of loan, which would potentially later convert to the capital. And this is convertible loan, or also called mezzanine financing. That means that investment is given as a debt, and there are some triggers which are predefined in the agreement, which converts this debt to equity. But of course, there are some traps, there are some huge legal risks to which startup is exposed, and these are mainly linked to the conversion trigger. So what is the conversion trigger, when this conversion happens, and also, of course, who can trigger this conversion? So is it only the investor? Is it a startup? Is this conversion obligatory or mandatory? So maybe if investor has only a right to convert but not obligation, or maybe if startup has the right to demand conversion or not. So that these are the questions that need to be very, very well defined in each agreement. And we also put this clause force majeure. Force majeure. Špela taught me how to pronounce it rightly. So we know what happened now with Corona crisis, and the circumstances change very rapidly on the markets. And as we'll see on the next slide, these conversion triggers can be linked to some business performance indicators. And of course, if something like this happens, like Corona crisis, when markets are closed, when business is practically stopped, then this convertible loan clause, the convertible loan agreement or conversion trigger clause can kill you practically. Meaning not kill the business, but meaning that startup would sell a major share in the company for a little money investment, and you need to be really cautious about it. So these are some of the convertible loan triggers. These are examples. As you can see, there are some negative triggers, there are some positive triggers. Unfortunately, we have experienced with our clients that these negative triggers actually happened. One of the reasons for one of our clients was mentioned Corona crisis. So this startup signed a convertible loan agreement with the investor, and one of the triggers was linked to the performance of the company in the last quarter. And of course, now we know that practically everything changed in the market, and now the startup is negotiating with the investor what to do next, how to let's say negotiate out these circumstances, and how to apply these unusual circumstances to their business relationship, to their relationship between investor and startup. So you can see here several examples. We have seen contracts which had more than 20 different triggers defined it, and of course this is something that you need to take into consideration and put a lot of focus on it when you are negotiating this kind of deal. And this kind of deal is usual for not only business angel investors, but also for accelerators and practically every kind of investors. But of course, there are some positive triggers too. In some cases, startups would like to see that in near future, investors or the people who gave them this convertible loan become also shareholders. So this is not something that can have only negative connotation, this convertible loan agreement, because of course the interest of startups are different, and in some cases, as mentioned, it is positive for the startup that the investor converts this debt to equity in the later stage. Okay.
So as Peter explained before, there is a lot of people that will promise you a lot of connections, a lot of investments, and yeah, basically to generate their leads into revenue for your startup. However, when you are dealing with these people, you have to be very, very cautious of their approach. If they are very pushy, if they are very aggressive, this can tell you a lot about their motivation. So it's usually like this: if they are very aggressive, they are in it for the money, not because they want to or help get you some business. So trust your instinct on that. Pay attention to their approach, because it can tell you a lot about their motivation. Now, the second red flag you should be aware of is when contemplating finder's fee agreement is if this middleman, this finder wants to or insists on an upfront payment. Now, just think about what happens if this person gets 5 upfront payments from 5 different startups in the amount of, let's say, $100,000. It certainly doesn't make him more motivated to work for it or to actually do some business, because he already got all the money even before doing anything. And the last red flag is connected to the formation of the finder's fee itself. You have to be aware of when do you have to pay the fee, so when is the startup obliged to pay the fee, and what are the KPIs? What does this person have to actually do to get this fee? Now, here is some examples of this finder's fee formulation. I'll give you a minute just to read through them and maybe form your opinion, and then we'll just comment it.
But don't copy paste it, because this one is really bad.
They are all bad.
Yeah.
Okay, so the first example is pretty obvious. It's problematic because it's an upfront fee. As we discussed, this isn't very motivational for the agent, for this middleman, to work for it. And as you see, the upfront fee becomes due in 5 days after effective date. Now, the effective day is usually the signing of the contract between both parties. So even before the startup gets any money, it already has to pay this fee. Now, the second example is problematic because of two things. Firstly, you can see it states that in case of successfully completed equity investment. So what is this? This is the first question. And the second problem is the amount that is specified as the fee. So 10% as a share of net investment amount agreed between the parties. Now, the third paragraph is actually connected to the second one. And it states that the successfully completed investment is when both parties sign the contract. So again, the problem is the same as in the first paragraph. The startup already has to lose money before even getting it. So it's not very ideal for a startup, especially because it usually doesn't have a lot of money when starting its business. And the second problem is regarding the amount of 10%. Well, like you probably already know, investments are usually in several tranches. And you decide, for example, that the first tranche is $100,000. However, the whole investment is 1 million. And as you see, 10% regards to the investment amount agreed between the parties. So the whole investment, not just the first tranche. So when the first tranche is actually, the first tranche startup gets, they already have to pay 10% of the whole 1 million, not just the first tranche.
And we know in practice that happens a lot, that startups not always do disburse the all tranches. So yeah. So maybe they can disburse only first and second tranche and third not. And what Špela was trying to tell you is that it's very, very wrong if you define this finder's fee based on the calculation of the whole amount, not on the specific tranches.
Yeah. And the fourth one, it's good that the parties decided to transfer, to pay the fee when the money is actually transferred. However, it's still connected to the second paragraph when it states 10% of the whole amount of the investment. So it's not regarded just for the first tranche, but the whole investment. So startup loses a lot of money, even though it didn't got that much.
So from the startup perspective, definitely the crucial point is when startup gets money on their business account, not when agreements are signed. So be very careful. Be very careful. A lot of different agents are on the market. As also Špela mentioned, if they will offer you some services for huge or even for any kind of upfront fee. Just picture the case in practice. So they will collect money from several startups, and then they will approach potential investors with tons of the startups. They are not credible, and this will be hard for you to get the service they're promising. But of course, this is not all such agents are bad on the market. Here in Slovenia, we have Slovenian business angels. They will help you to get business. They play fair. So don't be afraid of them, but be very cautious. So as what we wanted to show you with this example and with the previous examples is that the devil is in the details. Devil is in the contracts. So don't sign anything if you don't understand it very well. These are our contacts. Really feel free to contact us. Anytime. We work 24/7. We will be very responsive. So this was in short about negotiations in practice. We will stop sharing the presentation, and we'll look some of your questions. Okay. Yeah, Norma, you have our contacts. Please feel free to contact us. Miron. Yeah. Okay. So of course, Miron's question about having investor in a board of directors. Board of directors means that you would, everybody who is there, who is sitting in the board of directors, have executive function, meaning that this will be part of day-to-day business. That this kind of person will have influence, impact on daily company's operations. And of course, I wouldn't give this kind of powers to the investors at the beginning. Maybe at the later stage when you are negotiating, I don't know, Series B, C, but not at the beginning. But and of course not with a small investment. Start with the offer for the advisory board seat, and later if needed, and of course if this will be in both interests, not only in the interest of the investor but also in the interest of the company, why not letting somebody taking the position of the executive director or the member of the board of directors. So I would say that the question is not, the answer is not clear yes or no. Depends on the company. Depends on what would be the input of this director. So if this is a industry expert and it would help company grow fast, then why not? Cool. Špela, do you have something to add?
No. Thank you very much for listening to us.
Okay, we hope you learned something new. Don't be afraid of lawyers. Be afraid of investors and partners and business partners with bad intentions. Yeah. Okay. Enjoy. Bye bye.
Have a nice day.